Good morning, everybody. Thanks very much for joining Paycheck's first webinar session of the year in what is looking like to be a very sunny day down here in London. So I hope it's the same for you wherever you are. I'm really pleased to introduce to you Becky and Mike from our partners Chase de Vere, who today will be giving you a bit of a run through and insight on the spring budget changes. So without further ado, Becky, over to you.
Thanks, Mark, and welcome to everybody from Chase de Vere also. Are you going to pop the slides on, Mike?
Yep.
Yeah. So the session this morning is Chase de Vere's view on the 2023 spring budget and some opportunities that we're going to discuss with you all around some of the announcements that were made for you and for your business. My name's Becky, or Rebecca Dorian. I'm a corporate advisor at Chase de Vere, so my area of specialism around advice sits with advising businesses, and I've got my colleague Mike Lashbrook, who I'm going to hand over to shortly, who's going to handle the main content of the presentation. And Mike is a private client advisor, so his area of specialism would sit usually with advising individuals, but where the two sides of the business at Chase de Vere work quite nicely with the corporate division that I work for and the private client division that Mike works for, is that sometimes there is a bit of a crossover, and especially with smaller organisations, there's often a desire to meet objectives of the individuals as well as the business. So Mike and I can work jointly to provide you with comprehensive advice on both the business and on the individual side. The objective of today's session is to aid you in understanding some of the key changes that took place and what they could mean for small business owners and then your financial planning. And the agenda for today, and appreciate some of these items do sound a little bit heavy, but Mike's going to bring these to life with a few examples, which always helps. We're going to discuss changes to the lifetime allowance for pensions, and including an outline of what the maximum tax-free cash amount that individuals will be able to take from their pension will be. Detail on the changes announced to the annual allowance, which is the maximum amount that you can pay into your pension scheme now, and retirement planning opportunities around that. We're going to give you a bit of an economic outlook, so from Chase de Vere, with some more detail on what we expect to happen with inflation and also interest rates. That's obviously two key items that are of interest to most individuals and businesses. Some examples on extracting profits, and again, Mike's got a little bit more detail on that, but you'll find that there's been a bit of a sea change in whether the best way to get money out of the business is via dividends or via bonus payments. And then just at the end, we'll bring it all together with some business protection considerations. So just some additional key things that you might want to think about in relation to your business. Over to you for the content, Mike.
And I just want to say, sorry, Mike, before you start, if you've got any questions, then please put them in the chat and we'll cover those off at the end. Thanks very much.
Thank you, Becky. So yeah, we'll start with some of the key changes around pension legislation that came in the budget. I think on the whole, with regards to pension changes, they were quite kind of nicely received. In the main, they're all very positive, giving opportunities for individuals, businesses, owners to make more financial planning without some of the tax implications that can be suffered, particularly around exceeding allowances over the lifetime and on an annual basis. We'll start with the lifetime allowance. The lifetime allowance is the maximum amount that you're allowed to sort of pay into pensions and accumulate in your pension account where you receive tax advantage growth, so no income tax, no capital gains tax. And the annual allowance, the lifetime allowance, sets the limit that you can accumulate before you may have to pay additional taxes. For 2022-23, the lifetime allowance was set at £1,073,100. Previously, before that, the lifetime allowance was much higher. But in 2016, this was reduced right back down to just £1 million. And since then, there have been some inflationary increases to that £1 million figure, which gave the 73,100 limit for last year. There are some protections that are in place, primary, enhanced, fixed and individual protections, which protected pension values that were already over £1 million at the 2016 reduction date. The key thing in the lifetime allowance change in this spring's budget was that the lifetime allowance tax charge, usually 40% or your marginal rate, depending on how you drew your pension, was reduced to nil, effectively removing lifetime allowance tax charges from pension planning. Now, the lifetime allowance is quite heavily woven into pension legislation. So whilst the lifetime allowance is still in place, there is going to be hopefully a future finance bill that totally removes the lifetime allowance from pensions legislation, but that will come at a future date. The lifetime allowance figure of £1,073,000, unless you have your own individual protection, is remaining in place, and this will be used to cap the amount of tax-free cash that is available from pension schemes, which, as it stands, is 25% of the lifetime allowance, 268,275. Again, unless you have your own individual protection, where the lifetime allowance is higher, you get to keep 25% available as tax-free cash. Should your pension pot be above that lifetime allowance, then clearly tax-free cash availability is restricted. Moving on to the annual allowance. So this is the amount that you can pay into a private pension or final salary pensions each year without incurring any additional tax charges. Again, changes here, widely positive. Last year, the allowance was set at 40,000. And again, that has been a reducing allowance over the years, with 40,000 being in place now for probably the last 4 or 5 years at least. But from April this year, that allowance was increased to 60,000, and the retention of the carry forward allowance is still being made available for the previous 3 tax years. And we have an example on the next slide, just to confirm how the annual carry forward allowance works. But certainly the increase in annual allowance does give individuals and business owners that wish to extract profit much more scope to move business profits to personal pensions, given that the allowance to do so has been increased, whilst retaining any unused allowances for the previous 3 years. 2023-24 will see the tapering of that annual allowance remain in force. And this is where individuals have income over 200,000 and adjusted income, which includes pension contributions over 260,000. Again, this has been uplifted with the adjusted income moving up from 240 to 260, which again, for individuals that are in that position, they will retain more of their annual allowance and reduce some of the taxation they might be finding themselves in with regards to contributing to pensions. With regards to carry forward, you can see that over previous years in this example, the annual allowance was set to 40,000. And in this example, they've contributed 15,000, 15,000 and 25,000 in the previous 3 tax years. The unused allowances are all able to be carried forward through to the current year, where the annual allowance is 60,000, which means that potential pension contributions for the year could be as high as 125,000. But obviously will depend on previous year's contributions, whether previous allowance have been used. But it does give quite a wide scope, again, for additional pension contributions this year and extraction of profits from limited companies as employer contributions. One thing to note on carry forward is that you would have to have been a member of a UK registered pension scheme in the previous 3 tax years in order to utilise carry forward allowances. The money purchase annual allowance was also increased in this year's budget, And this restricted the amount of money that individuals could add back into their pensions after they've already taken taxable income flexibly from their existing pension schemes. Now, the reduction was moved right back down to £4,000 as the amount you could then contribute if you continued to work after accessing personal pensions. And this has been now increased back to £10,000 for this tax year. So again, another positive increase to allowances and for future planning this year. So in summary, saving for retirement, the tax advantages are significant. Where we're making personal contributions, depending on your business type, if you're a sole trader, for example, or if you're making personal contributions, there is tax relief at your marginal rate on any contributions made. So for every £10,000 paid in, the pension contribution is uplifted to 12,500 with that uplift paid by HMRC. For non-earners, the limit is capped to 3,600. But for tax relief on personal contributions, that can be up to 100% of your taxable annual earnings. Business relief remains for all employer contributions. So for those with maybe limited companies, carrying profits and cash, pension payments made by your limited company to your personal pension will be an allowable expense, reducing your profit, with the company then receiving tax relief via corporation tax. We've discussed the allowances and those were all positive, increased contribution limits and the ability to reuse your previous 3 years remain unchanged. And importantly, the lifetime allowance tax charges are now no longer restricting accumulation of pension assets above higher levels, where that may well suffer additional tax charges down the line. And overall, within a pension, tax advantages are that you can invest your money with no income tax, no capital gains tax, so it's tax efficient growth. Pensions can be accessed from age 55, with this increasing to 57 in 2028 and then in line with state pension age. And when drawing pension benefits, 25% of pension values will remain available as tax-free cash, subject to the lifetime allowance limits, which gives good control when retiring over how much tax you pay and how you draw your income. Moving on to economic outlook, which sort of feeds quite nicely off the back of pensions and additional planning and putting more money into invested pensions. For those of you that have had pensions or investments that have had valuations in the last 6 to 12 months, I think you will have seen some reduction in plan values, and 2022 was quite frankly a horror, but a horror that's probably unlikely to be repeated. And this is shown on the sort of the chart here that we have, which plots the performance of US stocks and bonds over the course of the last 96 years. What this does, it puts a point for each year, and where bond and equity performance was positive, you see a mark in the top right-hand box, and where bond and equity prices were negative, we get a mark in the bottom left-hand corner. Now, it might be difficult to see, but the orange dot was 2022. And as you can see, quite frankly, bond and equity performance both fell, which has only happened 4 times in the last 96 years. And significantly, 2022 saw bonds and equities fall probably the most out of all of those previous 96 years. But looking forwards, we believe that the growth outlook will improve through to the end of this year. And should there be a recession in the UK, we feel that will probably be mild and brief. Our investment team are obviously analysing lots of data and lots of charts on the economy globally. I just want to touch on a few points without getting into, I guess, too much detail on some of these areas, which sort of feeds into our view that towards the end of this year and into 2024, think the economic outlook is looking a bit more positive. So on inflation, you may have seen that UK inflation for April this year was down to 8.7% from peaks of over 10% last year. I think historically, outbreaks in inflation tend to subside usually a year or two after their peak. And the main issues and the main driver for quite a rapid hike in inflation was obviously the pandemic. And the further we move away from the pandemic, the more likely we are to see a more rapid decline in inflation. Some of that's already feeding through in the data that we're seeing, with commodity, food, energy, transport, and supply chain costs all falling down from their peaks. And obviously with falling inflation, it leaves more money in our pockets. It gives us more purchasing power, and in turn, we can go and spend more, which is supporting of growth in the economy. Interest rates lead quite nicely off of inflation. Obviously, recent interest rate hikes are put in place by the central banks in order to get inflation back under control. But I think we see that these hikes are slowly coming to an end. The US Fed lead rate changes globally, and we maybe expect one more hike in the US and then a pause to rate hikes, with inflation already starting to come down. Now, the Fed rate is important because this sets the scene for global rates, and where they're sort of looking to pause rate hikes, it sets the scene for the rest of the globe. And with rates sort of leveling and interest rates potentially falling again towards the end of this year, this tends to support growth around 6 to 9 months after rates start to pause and come down. Chinese reopening, so they were in additional lockdowns post-pandemic in relation to the rest of most of the globe. But the Chinese reopening has been swift, and the Chinese economy actually registered really strong growth in Q1 this year. And importantly, the Chinese housing market came to a 2-year high, which is important because much of Chinese wealth is tied up in property, and therefore raising property prices does improve consumer confidence in China. Lockdown savings in China are being spent, with retail sales up over 10% year on year in Q1, which is going to give a boost to their economy. And all of those things kind of are supporting the Chinese economy, which is the second largest in the world. And that in turn will feed into and support global growth. On European energy, gas storage in Europe was 55% full at the end of the winter, and that's the highest level that we've seen on record. European natural gas prices have also fallen around 87% since their peak in August 2022. So prices are coming down in that part, which was the key driver in inflation jumping up. And in July this year, we will see Ofgem reduce the energy price cap, which is going to give much needed relief to consumers in the UK. Again, we're feeding back to the inflation rate coming down and putting more money kind of back into our pockets. And then just a summary on global conditions. The mini banking crisis, obviously in the US, has been an issue this year, but that has brought down future interest rate expectations, which will also have an impact on future borrowing rate expectations. And if those rates are lower, it makes borrowing costs much cheaper. And US dollar and commodity prices have also declined meaningfully from their peaks in 2022. This means that globally doing business is much easier than a year ago, which again is going to lead into some more growth in maybe 6 to 9 months' time. So I think all of those things coming together give us a bit more of a positive outlook. I think it can't be much worse than 2022, with it being a bit of a horror show. I think importantly, sort of feeding off of the pensions talk, now is certainly, the right time to be looking at what planning you might have in savings, investments, pensions, making sure you're reviewing and taking control of those pension pots. There has been lots of change in economies, lots of change in markets with high volatility, but with markets starting to show signs that there could be some improvements on the way, certainly the right time to dig out those old pension statements and investment accounts and sit down and see where they're at. In the moving on to corporation tax and budget updates in that area, I did read this interesting article around extracting profits in 2023. I think in the main, it's generally been accepted that most limited company owners, for sure, tend to draw a small salary, the rest of dividends because of the lower tax rates. But there has been some slight changes to corporation tax for this tax year, which means that that position may well change in certain scenarios, and we have an example to follow. So the main changes were for corporation tax this year, companies with over 250,000 of profits, subject to an increased corporation tax rate of 25%. Companies with profits up to 50,000, subject to the relief smaller companies rate, which is the existing 19%. And there's some relief for companies with profits between 50 and 250,000, which means they pay tax at 19 on the first 50, profits at 26.5% on the excess above that 50,000. Now, as I said, with the high marginal rate above 50,000, changes to income tax and dividend tax reliefs on the personal side, this could tip the decision in certain scenarios whether to draw bonus, taxable income, or drawing dividend with regards to additional profit extraction from your company. The example we have here is a company which makes pre-tax profits of around 120,000, same as previous year. The owner is a high rate taxpayer, income of around 60,000, but wishes to draw an additional £30,000 of profits from the company. Now, the cut in the dividend allowance basically means that the dividend is almost entirely taxable. And in the past, as I've said, drawing dividend has usually been better than drawing additional money as bonus or income. What we can see here is just some comparisons of bonus and dividend. As we can see for 2022-23, where this was drawn as bonus, obviously we have profit, employer national insurance, and then we get a net income paid to the owner of 15,000 and a pound. And in 23-24, this actually becomes a bit more advantageous, with slightly more being received in the hands of the business owner. 2022-23, position was slightly different, obviously much more favourable tax position around dividends. So by comparison to 22-23, £16,436 net received compared to 15,000 and a pound. What we're seeing in 23-24 with the increase in corporation tax, a £30,000 dividend would only result in about 14,600 net in your hand, and clearly drawing that via bonus is giving a higher figure. Obviously, this is a specific example in relation to profit levels and income tax levels generally of the business owner, but it is certainly something to bear in mind with regards to how you're drawing bonuses, dividends, or additional profit over and above your normal pay or paychecks that you have through 23-24 tax year. I think my final slide is an area that I focus on for a number of my clients, where we have individuals and limited companies for small business owners, and sort of the crossover that comes between your business and your own individual personal circumstances. I think protection for small businesses is essential. We tend to have four main categories that we identify and work on with our clients, and we kind of rank them in some order of priority there. I think the obvious one of protecting loan and liabilities, most people are fairly familiar with, similarly to protecting your personal mortgage. protecting any loans to the bank or any other creditors is important within your business to ensure that if someone was to die or if someone had a critical illness or couldn't work for a long period, that those liabilities don't become the factor that stops your business from progressing, and they can be cleared and wiped, for example, on the death or critical illness of an owner. I think what's maybe less familiar is directors' loans. So where there's a director's loan in place, on the death of an owner, that loan is actually called upon by the director's estate. So the company would need to have sufficient cash reserves to actually pay the loan that's outstanding back to the deceased director's estate. So in that scenario, protecting that liability, whilst it might seem like a close-knit, relationship between the owner and the company, the estate will want that money back when that's being pulled together, and you wouldn't want the business to fall foul or suffer as a result of not having cash available to do that. Moving on to key people, certainly in a small business, that can often be the owners themselves who drive turnover and profit, but it may also be other employees of the business who have significant contacts or have a significant impact on turnover and profitability. Essentially, the business would be looking to make sure that if something happened to those individuals, that it has sufficient cash from an insurance policy to make sure that it can replace any lost profits or turnover, source a replacement, and again, if that individual has specific skill sets and they're working on special projects, that those projects don't fail through the lack of being able to recruit someone quickly, have the cash in place to go and get the right person. Shareholder protection, we do see this as an area for small businesses, but tends to come more into play as the business grows. And essentially, here you are protecting individual shareholders against the loss of someone else. And the example here, I guess, is that if two people own 50% of the business and one of them dies, the default option is for their share of the business to pass to their families or their spouse, who may have little to no interest in the business and may have maybe no business acumen to come in and be a controlling shareholder at 50%. So what our shareholder protection policies will look to do is provide the cash on death or critical illness of a shareholder and put that in the hands of the surviving shareholder. They can then use the cash to buy the shares, deceased. The surviving shareholder retains the business, and the deceased estate and their family then receive the cash for their share of the business. Now, some of you may have some agreements like this in place, either in your Articles of Association, or you may have had a shareholders agreement or company will put in place. These protection policies are essentially the facilitation of what's in those agreements. The last point to finish on there is directors' benefits. Again, something I think is almost essential for all limited company owners who put their blood, sweat and tears into their businesses. These are policies which provide for you and potentially certain employees, and offer some tax advantages in making these arrangements as well. Now, relevant life policy is essentially a life cover paid for by the business on the life of you as the director or as an employee, and essentially is probably more commonly known as like a death in service type policy if you've had experience of working in bigger companies. On claim, the policy pays out, and it's paid out to the deceased directors or employees' families. The tax advantages here is that the company can pay the premiums. The premiums are allowable expenses, which means it's a reduction to your profit corporation tax. With the benefits paid on the life policy paid via a trust directly to the family, meaning there's no inheritance tax or income tax or any other taxation needs to be taken into account. So again, a really tax efficient way of business owners providing for their families and the well-being of their employees' families as well. Executive income protection runs on a similar note. The difference being obviously is if you're unable to work. The policy again arranged by the business, and the policy proceeds on claim of the individual insured being unable to work through accident or illness and do their occupation. The insurance policy pays the business a sum equivalent to their usual pay, for example, and the business can then continue to pay the individual while they're off sick. So I guess in a nutshell, if you're providing sick pay to yourself or an individual that you'd like to provide those benefits, an executive income protection policy for the owners can meet the costs of paying that sick pay, which means that you can bring someone else in without having significant financial impacts on the business. Again, premiums for those types of policies, generally an allowable expense, reducing corporation tax, reducing profit, and then any payment into the business from the policy out to the employee is dealt with via PAYE. Brings me to any questions?
I've not seen anything come through, Mike. Thanks very much. That was brilliant. So obviously it's all explained very clearly. People understood what you're saying, so that's all good news. If you do have any questions, then by all means, please email us at marketing@paycheck.co.uk, and we'll relay those back to Becky and Mike to cover off. We will be doing a further webinar with Becky for Chase to Vere later on in June. So please do follow us on our LinkedIn profile, and you'll be updated as to when that's released. And that's going to be on salary sacrifice and salary exchange. So that might be of interest to you as well. So thanks everybody very much for your time today. Hope you have a good rest of the day, and we will speak to you soon. Take care. Bye.